We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
Like, I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just wanted a better financial picture.
And so when Earned came onto our radar and we sat down with our financial advisor, it just felt different.
I think a physician specifically should look at Earned because the focus is on our field. They know what a physician goes through at different phases of our career. To have that knowledge in order to guide us, I think is just such an advantage.
Earned isn't just about giving us financial advice. They're about doing the things that are needed to be done in order for you to fulfill your financial plan that they have created with you. And that really was very meaningful to me.
Earned is kind of like the conductor of an orchestra. You know, you pull in the trombones, you pull in the trumpets, you pull in the percussion. But Earned is the one that's holding the baton. I feel trust that they're taking care of my entire financial picture, not just one little part of it.
As a physician, I know that what I do for people is really powerful and impactful, and it's important for me to know that the level of expertise that I'm working with for my financial health is there, and I have that trust for them.
It's definitely valuable because I don't have to go looking a million different places. Like, I don't have a lawyer over here, and I don't have, the insurance thing over here. Everything's under one roof.
Earned brings clarity to my financial life.
With Earned, I feel really well taken care of.
I feel my financial health is secure.
I feel supported.
Earned is security.
I would highly recommend any doctor to look at Earned.
I love what I do, and it's really important for me that my patients have the utmost trust that I'm taking the best care of them. I have that same amount of trust with my financial advisors at Earned.
Hello, everyone. Welcome. We are so excited for you to join us today for How Doctors Can Give Tax Efficiently This Season, brought to you by Earned and Physician on Fire. I'm Amber, Marketing Manager at Earned. I will be your moderator for this webinar. Earned is a longtime partner of Physician on Fire and the first fully comprehensive tax and wealth firm built specifically for doctors, families, and their practices. We bring tax planning, investing, and retirement strategies and practice level advice all under one roof, so your whole financial life works together. Before we get started, a few quick housekeeping notes. We're excited to welcome you to our new platform. It's new, it's improved, and it's designed to make registration, viewing, and interacting even easier for you. As you will see, the question icon and the chat icon are on the bottom right-hand corner of your screen. Please feel free to drop a hello in that chat. And if you have a question, click on that questions tab, and you can put your questions in the bottom. We will be happy to answer any of your questions at the end of the webinar, or if you have more personalized questions, you will have contact available so we can get those questions answered for you as well. So we're excited to have Jeanette and Jorge with us today. Jorge, as many of you know, leads the Physician on Fire community and has been a champion of financial freedom for physicians. So we're excited to have our featured speaker today is one of Earned's dedicated wealth advisors, Jeanette, who has deep experience helping physicians build tax-smart, efficient financial plans. Her work focuses on strategies that matter most to high-earning healthcare professionals, for long-term investing planning to integrated and tax charitable strategies. Today, Jeanette will walk us through how physicians can give more effectively, use smarter charitable tools and take advantage of the current tax landscape before the 2026 changes arrive. So without further ado, Jorge, join me on screen. Say hi to our audience.
All right. Hello, doctors. This is Jorge from Physician of Fire. Welcome for another webinar with Earned Finance. Excited to be here. For you doctors, you know how to stop a bleed. We got taught in medical school to apply pressure at the right point. With tax season coming around, we're in the last quarter of 2025. It could feel like you're watching your hard-earned money being hemorrhaged to Uncle Sam. The good news is strategic charitable giving is like putting a hemostatic agent for taxes. Done right can control that bleed and preserve what you're so hard to earn. So without further ado, let's introduce Jeanette Beatty, CFP over at Earned.
Hi, thank you, Jorge. Can everyone hear? Can you hear me okay? I didn't know if I got some feedback.
We can, Jeanette. Welcome.
Great. Thank you. So today we're going to be talking about how physicians can make their charitable giving more strategic, not just generous. Obviously, given the work you do, you give so much back to the community as a whole, and it's very common for physicians also to be charitably inclined. So we're going to talk about how we can work beyond just that generosity and also build a genuinely effective plan in supporting the causes you care about while strengthening your overall financial picture so you can do more of what's important to you. We'll look at why year-end strategies matter, what's changing between this year and next year, and some things you might want to take advantage of while we're still in 2025. 3 ways to give more efficiently, and how to use these ideas how these ideas come to life with real-life client situations. My hope is that this gives you clarity and confidence as you think about giving over the next few months and into the future. So your wealth strategy should be tax efficient. I think that goes without saying. Doctors face a unique set of financial challenges when we're building out financial plans. Oftentimes, physicians have a high student debt load. They have a long trajectory before you're earning at higher levels, a compressed earning window, so that reduces the amount of time we have for compounding. Oftentimes, physicians, because of that compressed period of time, that long training period, you feel behind perhaps on retirement planning. Career burnout is a true and consistent thing that we see among physicians, and also high tax burdens. Oops. Sorry. There we go. The median marginal rate for doctors is the 35% tax bracket, which is the second highest tax bracket in our current tax regime. But there's still time to be strategic in 2025. There are a couple of steps that we can take advantage of in our current tax rules before they change after the passage of the OBBBA or OBBBA. Strategic giving in 2025 can lock in valuable deductions under today's current regulations. So what are some of the changes that are coming up in this next year, like the changes coming forward in 2026? As we know, tax laws are not permanent. Even if we call something permanent, things ebb and flow. So we always want to be in financial planning, strategic and flexible when we're building out financial plans. So this great change that happened over the last year, this large change to the current regime, is something that we're keeping an eye on. So for our clients and for physicians like yourselves, we always want to know what the changes are going to be and how they're going to impact you. A big one is going to be the change in the floor for the AGI deduction if you're going to be itemizing your charitable giving. This means that the value of your deductions may be capped, which would reduce the tax benefits. So 2025 is a crucial year for tax efficiency. So essentially what's happening is this year, you're looking at your charitable deduction rule will shift, And after this year, and only giving above that 0.5% threshold will be deductible. So you're essentially taking, if you do itemize, a 0.5% haircut on the value of your deduction in 2026 and beyond. So if you are charitably inclined, 2025, getting that deduction done in 2025 or bunching those deductions could be an appropriate strategy for you in your overall financial plan. I just want to see if there's anything else we need to touch on here, but I think we're good. So yeah, we have a couple more weeks to get this done. So this is really a big one. Most folks have a tendency to give charitably in cash only gifts. The downside to doing this is that it's a big missed opportunity from giving when you give exclusively in cash. While it's easy to write a check or make that one-time deduction or contribution to a charitable cause, it's not often the most tax efficient way to go about it. Cash giving doesn't allow you to avoid capital gains, and it may limit the deductions that are available to you, especially if you have appreciated assets sitting in your portfolio over the last 10 years. I'm sure we all have appreciated assets sitting in our portfolio. There's typically better tools available that will allow you to stretch the impact of your charitable dollars here. So for example, if you have I've had clients in the past who had stock that they received from their employer through RSUs. And while those, if you were to sell those and realize that large capital gain, that would have like a pretty big impact to you, and then give like the proceeds from that sale directly to a charity, it would mean you're still paying the taxes. You can gift appreciated stock to directly to a charity, and that allows you to take that deduction, and the charity doesn't pay taxes on it. So it's a win-win for you and the organization that you'd like to support. So this just digs in a little bit more into the benefit of donating appreciated assets. Donating appreciated investments is one of the most powerful charitable strategies available to physicians. So when you donate an asset you've held for more than a year, you can take a deduction for the full fair market value and avoid the capital gains entirely. So for physicians with high incomes and meaningful investment portfolios, this approach can significantly increase the value of your giving. So you deduct the fair market value at the time of the gift, not just your original cost basis, and you avoid capital gains tax and net investment income tax entirely on the appreciation. And also, of course, your organization of choice doesn't pay the taxes on the gains either. To illustrate this, imagine an investment had grown considerably over time. Instead of selling it and recognizing the gain, donating the asset allows you to support the organization you care about while removing the capital gain from your tax landscape. It's one of those strategies that's both financially smart and deeply aligned with your philanthropic goals. So again, just to illustrate like the impact, especially when you're in a high income tax bracket, you had $100,000 is the fair market value of a donated stock. Your original cost basis was $40,000 and it grew to $100,000. There's $60,000 of capital gains avoided for tax-free appreciation to the charity. That means your full tax deduction is $100,000, even though and you haven't paid any taxes on that $60,000 capital gain. It's a huge savings. Another strategy, something that you might really want to look into this year, is taking advantage of charitable bunching through a donor advised fund. So what is a donor advised fund is you make one single contribution in cash or appreciated securities, and you receive the deduction right away. And then you distribute grants to various organizations over time. So this is especially effective for physicians who take the standard deduction or whose income varies because of contracts, buyouts, partnerships, change in your career position, moving from, residency to practicing, or, reducing hours, or things like that. So you can take the opportunity to bunch multiple years donations into 1 year's contribution. So if there's a charity that you give to on a pretty regular basis, but you are not hitting the threshold for the standard deduction, you can take those deductions and group them together over a couple of years. 2025 would be a great year to take advantage of that, since we're going to have that change to the 0.5% floor for the AGI for charitable giving starting in 2026. So 2025, you want to be able to take advantage of the larger deduction. So essentially, a donor advised fund is like a charitable investment account. It lets you give now and then grant later. So you have the ability to control the timing of the grants. The charity receiving the funds doesn't know you have you front loaded a donor advised fund. They just see the distributions you make over time each year. So it's really great, and you get to deduct that full fair market value in the year you do it. So if we look at, this is a hypothetical example from a client that we had, or not hypothetical, but from a couple that we have worked with. They were gifting pretty generously each year of about $44,000, a little over $44,000 every year to their different charitable organizations. You can see they took the standard deduction that through all of that, their total deduction and their total gift was $269,000, and their total deduction was $310,000. So if you were to look at bunching these gifts, essentially combining the gifts into every other year, you can increase your total deduction and keep the amount of gift the same, but increase your total deduction significantly. So this is just an illustration of how that works. This allowed them to deduct an additional, just doing this strategy, even when they were already saving at a pretty high threshold or giving at a pretty high threshold. This allowed them to deduct an additional $67,000 from their taxable income, and at a high tax rate that's pretty substantial. Another opportunity for giving before the end of the year, and this is really more for folks who are taking their who are already retired and taking their RMDs. And actually, this is that age, I think, is incorrect. But for people who are taking their RMDs, you can send your RMD directly to a qualified 501c3 charity of your choosing, and that would allow that to you to exclude that amount of money from your income and also go directly to the charity of your choosing. So if you're already retired and you're already of RMD age, you can give up to $108,000 per individual, or $216,000 per couple, and that allows you to give directly to a charity. It allows you to satisfy your RMD, which, if you have large IRAs and you're going to be giving to charity anyway, you might as well exclude that amount of money from your income. And it also allows you to preserve your different medical expense deductions and keep your, starting in 2026, the 65 plus senior bonus in the standard deduction. So this is a really great way to take advantage of that to satisfy your charitable giving inclinations in a tax effective way, while if you are retired. So what you want to do when you're considering, well, how can I be smarter and more tax efficient with my charitable giving? The core idea across all of these strategies is simple. The asset you give matters just as much as the amount. So choosing between cash that you have on hand or from your wages, securities, or IRA distributions can dramatically change the financial impact for both you and the organizations you support. So donor advised funds you can give to IRS qualified public charities. You're able to, like there's growth potential because the funds are invested, that you can do donations of non-cash items. And then this just digs into a little bit more the specifics of the impact on your overall taxes. So you can also donate to charities anonymously, which is really great for some folks who prefer to do that. You have the ability to name successors to the donor advised fund. The donor advised fund is great if you want a turnkey solution with low costs and the potential to grow tax-free over time. There's also charitable lead and remainder trusts. If you are in a position to be retired, this might be a more complex strategy that you want to look at building a long-term legacy for income for you and your family, and a large charitable gift at the end to heirs and charities. So that's really something to think about when you're building out your estate plan. So before you give, you want to confirm your charity, the eligibility of your charity. As we begin using more advanced strategies, it's important to ensure that organizations you're giving to are eligible for charitable entities and that structure of your gift meets the IRS requirements. So this part is, straightforward, but it's something I help clients navigate regularly so their giving is both meaningful but also compliant, because if the charity doesn't qualify, then we're losing the tax benefits. So there's a database called the IRS TEOS, the Tax Exempt Organization Search. You can confirm if your charity is a 501c3. Qualified charitable distributions from an IRA cannot fund donor advised funds, so you can't double dip there. So only direct contributions to a 501c3. And these organizations are very happy to guide you through that process if that's something that you're interested in doing. You always want to obtain proper written acknowledgement from charities for donations over $250 and keep detailed records of all the charitable contributions for tax purposes. And if you are an earned client, we have our great portal where you can keep those receipts and charitable documents all in one place right alongside your financial plan and your taxes. So our planning model at Earned integrates charitable giving with financial planning, investment strategy, tax strategy, and practice planning, all the tailored unique realities of physicians and healthcare professionals. Your giving is part of your broader financial life, and we design your plan with the bigger picture in mind. We really do believe your financial plan integrates across all aspects of you and your practice. So we start from a goals-based approach. Charitable giving is a large goal for a lot of our clients, and we want to be sure that we are building a tax-efficient strategy that also provides for financial stability for you and your family and generations to come. Our approach is built to create all-weather, tax-efficient, diverse, and long-term resilience strategies like tax loss harvesting, custom indexing, and thoughtfully incorporating alternatives create more opportunities for us to invest in tax smart ways. The more money that you keep in your pocket, or the more money that you are optimized in your tax saving strategies, allows you to be more generous with both your giving and your time. We really want to take advantage of these strategies, as Jorge mentioned earlier, so you're not just hemorrhaging money, you can be more intentional about where your funds go and achieve the goals that you have. We do incorporate, again, custom index solutions, which allow you to, if you want to further support causes that are important to you, we're able to screen your custom indexes for things like the social responsible screens or religious screening. We continuously tax loss harvest in our portfolios to build up losses to offset large gains, so future practice sales or things like that. We build out our portfolios from true diversification. So we include in those alternative investments. So if you're also concerned from a tax perspective on, or you want to take advantage of some other tax savings vehicles like, again, charitable remainder trusts or opportunity zones, we can help you with all of that as well. So since we integrate tax efficiency and technology across our wealth platform, we think about utilizing national, state specific municipal bonds and customized SMAs to leverage tax-free income. Again, we're looking at part of the more money, the less money you pay in taxes, the more money you have to go towards other goals, whether that's supporting your family, your retirement, or your charitable desires. Tax efficient tools like Roth strategy, opportunity zones, tax reporting all work together to give you more control. And this level of integration allows your charitable strategy to be proactive rather than reactive. And it can compound the impact of your desired charitable giving. We also talk about, again, taking timing and strategy around Roth conversions, Roth contributions, tax transition planning, tax bracket planning, overall budgeting. This is all part of your financial plan. We want to level out your taxes over your lifetime and be as efficient as possible. And we help our clients with that every day. As fiduciaries, our guidance is aligned with your best interest. Our fee structure is transparent, scalable, and designed to support long-term partnerships. We help physicians build clarity, confidence, and consistency, not just in investments, but across their entire financial life, including areas like philanthropy. But here at Earned, we are able to offer you solutions across all different areas of your financial life, all in one place. And we really believe that everything talks to one another. I think like in the video, they talk about Earned as the conductor, and we really do value that role. We offer comprehensive wealth building solutions for doctors and their practices. And that specialization shapes our entire approach. Your compensation, your tax exposure, career transitions, financial needs are different from the general population. And your financial plan and your charitable strategy should reflect that. Every strategy we discussed today is for educational purposes only. I know we're talking at a very high level here. So your situation is unique, and the right approach will depend on your goals, your financial picture, and what matters most to you. So when generosity is paired with smart planning, the impact can be extraordinary, both financially and personally. So I want to thank you for taking the time to listen to this high level conversation. I'd be happy to answer some questions from you all and to learn more about you and your current situation.
Awesome. Thanks so much, Jeanette. We're waiting for Jorge to jump back on. That was wonderful information. Let's see if there he is. Awesome. Go ahead, Jorge. Kick us off.
Thank you, Jeanette. I think we have, so thank you very much for that, that interesting webinar. If you guys showed up late or had to be pulled away to see patients, you're going to get an email with a link so you can see the webinar in its entirety. We've been working with Earned for over 2 years. We actually were very involved with creating the POF Earned mobile app. I call it my CFO in my pocket. You can track your financial goals, explore your trends, monthly subscriptions. We were going over it the other day with my wife, and we actually have to do some homework over the weekend and go over our subscriptions and cut things that have shown up from applications. And of course, get all your POF content about finance and fire. So again, thank you very much. I think we have We have a couple of questions,
We
Amber. You said
do.
one?
Very, very excited for Jeanette to see if she can answer these for our viewers. So our first question right here, and I'm actually going to move it to a different screen so that way the question is front and center. John's question, it is, how do you donate mutual funds from a brokerage? Does the recipient need to have the same brokerage, house, or massive, as an account with the mutual fund company? Do you mind seeing if you can dive in for John?
Yeah. So in general, no, they don't need to have the same mutual fund, like the same brokerage account. It doesn't have to be like a Fidelity account to a Fidelity account. Oftentimes these charitable organizations, depending on the size of them, will have they'll have a liaison who will be happy to tell you what account information you need to provide. Typically, you'll do like what's like an in-kind charitable gift, and they will have a receiving account on their end. So you don't really need to know anything about like you need to contact them. They'll provide you all of that information, and your brokerage will know how to with that information, you'll send that direction to your brokerage, and that brokerage will send those assets in kind, which just means as is. So
wonderful. Thank you so much for that answer, John. Hopefully that helped you kind of answer that question. But if you have more questions specific to your situation, feel free to book that free consult so that we can kind of dive deeper into that. Our next question is from Denise. So she's a late joiner to the chat, but how do you know how much you need to contribute per year for it to be beneficial towards your end of year taxes based on your total income?
Well, I think I can answer that in general. So what we'll want to do is it really depends on where you are currently sitting in the tax brackets and what your current, like basically like we have to do a calculation through tax software to see like when we're going to push over the edge from you itemizing versus giving a standard deduction. And I hope I'm answering the right question. Depending on the state you live in, you might have different benefits that like kind of come along with that charitable giving. I know in some states you get an additional credit, like state tax credit for your charitable contributions. So really it's like, but in that illustration we looked at earlier, it's kind of like if you're going to be moving over that threshold from itemizing, you're close to that threshold, it would be better to itemize than to give the charitable gift without itemizing, because then you wouldn't get the benefit of that deduction.
Wonderful. Yeah. And to add on to Jeanette's explanation, Denise, I really feel like it totally is based on your specific situation. And that's what Earn does best is takes what you give us and all the information, really looks at holistically and comprehensively with all of our team members, right? So Jeanette is just one part of that puzzle, and our CPAs and all of our accounting like works together, and it's like she stated, a beautiful orchestra of services and help. So again, I hope that helped answer your question, Denise. But again, if you book that free consult, we can kind of dive into your situation specifically.
Yeah, a good way of thinking of it is like when you're consulting on a patient in a hospital, you want the consultants all together. For example, if you do estate planning, you got to have your lawyer and the accountant to talk to each other so that whatever plan you come up makes sense. So yeah, that's what I like about Earned. Jeanette, I have a question. And this may relate to a lot of the physicians. We've been writing as a family a lot of checks to my church, to my kids' school, a couple of medical charities a year. Like, how do you optimize that so that you still feel like you're contributing, but not feeling like it's not having any significance? And the last one, what if the charity that you want to donate to can't accept stock donations? Do you lose out on that tax benefit?
If you're not able to give the direct charitable, like the stock directly, you won't be able to take advantage in that way of like the foregoing the capital gains, right? From the appreciated stock. So they do need to receive it directly in kind. But with, with the, for any charitable and any like qualifying organization that you're giving to, and this of course is something that you want to verify with your tax team. I'd save those receipts and see what the compounding nature of like those monthly contributions that you're providing are. You can oftentimes use, those like at least reduce your taxable income by the amount of those contributions.
Yeah, I definitely agree with that, Jeanette. That was a really good way to explain it. Scott actually has another question.
Sure.
Let me put this up on the screen for us. Can a donation to a DAF come from a traditional IRA? Is the money coming out of the IRA ever taxed since it is going to a DAF? That's a really nice question. Yeah.
So again, I'll just offer like the disclaimer, like I am not a CPA, but it is my understanding that you cannot contribute directly from an IRA to a donor advised fund. You can't you can't fund a donor advised fund with pre-tax assets for that double tax benefit. Is the money coming out of the IRA ever taxed since it's going to a DAF? So it's not, so to answer that question, no, but if your intention is to give directly from IRA assets to a charitable organization, that might be something that you would do when you hit RMDs, and you can give directly from the IRA in those QCDs, the qualified charitable donations.
Great, Scott. I hope that makes sense. Again, let us know if you have any more questions in the chat. John, awesome. You have another question for us. Here we go. How does gifting using appreciated mutual funds work to non-charity individuals?
I think you're talking about like the annual gift exclusion. Is that right, John? Like if you were just trying to reach that $19,000 gift limit every year. So in that case, and if I'm just tagging on, assuming the thread is, do they have to have the same brokerage as me? I think that's probably where the question's coming from. Then oftentimes, yes, that's the easiest way. Like if you're going to give $19,000 to your children every year and you want to do that in an appreciated stock so they get the capital gains, which I've done a number of times for folks who have kids who are in maybe like just in college or they're not earning anything yet and you're in a higher tax bracket, you have a whole bunch of Eli Lilly or something like that you'd like to gift. So they would typically need to have a brokerage account, like for ease, have a brokerage account at the same organization as you, because then you can just journal the assets over. But that's again something to chat with like whoever your firm is.
Wonderful. And he says thumbs up. That's exactly what he was talking about. So thanks, Jeanette, for jumping into that. Jorge, did you have any other takeaways you wanted to tell us about before we say goodbye and give people back their day?
Yeah. Just one question though. Could you flash the timeline? Like, we have until the end of 25 to maximize the rules, but like, when do I need to set up my charitable contribution to be completed? Like, do I need to be done by December 31st? Like, what would be the absolute?
Do not do it December 31st. I mean, I think like, especially if you're going to use stocks, I would put that on your to-do to get done, by like, I think technically, yes, it has to be done by December 31st, but if you're just because of, you don't want to be messing around with that. So this is a big thing you're taking advantage of. Try to get it done by like the second week in December so you can cross it off your list and enjoy your holidays.
Got it. Oh, no, great. So thank you very much, Jeanette. Much appreciated. Earned Financial one-stop shopping. We've been working with them for 2 years. Again, another amazing webinar. For me, the takeaways from this webinar is act before the year end of 2025. The tax windows are closing. So that's number one. It sounds like 2026, the OBBBA changes will introduce a 0.5% AGI threshold for deductibility. Number two is stop giving cash, donate appreciated assets instead. And number three, match your strategy to your life stages. If you're under 70 and a half, use appreciated securities and DAPs to a bunch of donations. and exceed the standard deduction threshold. And if you're older, qualified charitable distributions, what it sounds like you were saying, from IRA directly to your charities, not DAFs, to satisfy your RMDs. Boy, that's a lot of acronyms. And I tell you, my doctors, we can handle as many acronyms as you can. So we got DAFs, we got IRMA, we got RMDs.
That's
So
right.
and much fun. Thank you very much, Jeanette. Thank you very much, Amber. And doctors, take care. You'll be checking an email where you can see this webinar in its entirety. Have a good one, and let's save America one patient at a time.
Awesome. Thank you, everyone. See you next time.